Hello and welcome. Rahul, you're watching my YouTube channel Rock Talks, and if you're watching me consistently, welcome back to my channel. See, whenever I come in front of you, I have a purpose. I want to instill positivity and disseminate some valuable knowledge so that if you want to get any advantage, of watching videos, you can leverage these informations. In this information age, we have conditioned our world in monetary values, so whoever have abundance, financial abundance, they can get, better standards, better opportunities, and that is what we want to provide you. Each and every time whenever I come in front of you, I try to talk about business knowledge as well, sometimes about spirituality, sometimes about science and recent development in scientific field. Everything I talk about today, I want to give you every blueprint of business. I have talked about how you can run a privately owned company, how you can start from scratches and make it even enlisted in public company, owned by private, that you can do also. Everything I have discussed, how you need two shareholders and minimum two directors to make up a private limited company. How you need digital signature certificate and director identification numbers. Thereafter, how you will enroll yourself in memorandum of association and article of association. When you get your certificate of incorporation, how you can go, as per the association, whatever you have agreed upon, the share capitals, when you deposit in your account, then you file again and you get your certificate of commencement of business. Your business is ready, then you get PAN and TAN along with that. In that way process, PAN and TAN is needed for tax purpose, for tax on resources as well. TAN is needed when your employee, when you will give them their salaries, the tax will be deducted, that will be remitted on TAN as well. PAN is for personal, assessment of tax. I have talked about how you need to create ESIC number, a state insurance number, corporation number for each and every employee, and how you can get even PF increase subscription. Everything I have talked about. Thereafter, your company is established, how you can leverage, credit, not only credit but investment as well from private venture companies, private equities, high net worth individuals, venture capitalists, angel investors, how you can explore all these opportunities I have talked about in my previous videos. So today I will suggest to, if you really want to watch those videos, you can go and navigate and watch that very video. Today I will be giving you short analysis and insight how you can understand exactly the financial statements of your company. That is also needed, not only establishment, but if you will understand exactly what are financial statements, you will have leverage, and that is what I want to make you understand. See, balance sheet and profit and loss statement are two most important components of financial statement. Thereafter, cash flows are there. So I will make you understand exactly how balance sheet analysis are done, how profit and loss assessment will be created. I will talk about manufacturing account, trading account, and profit and loss till net profit calculation. I will give you total step by step, how you will be able to arrive at net profit, and once you will have net profit, everything will be clear. All three accounts, manufacturing, trading, and profit accounts. And you should have knowledge of balance sheet, because at a particular date, balance sheet gives picture of your business, and every day balance sheet changes. Every financial transaction changes your balance sheet, and balance sheet is the picture of your business. How you will understand exactly what balance sheet holds, today I'm going to deliberate on that. So there are two sides. One is liability side, one is asset side. Liability is also called sources, and asset side is also called uses of funds and sources of funds. So in liability side, you have your net worth, capital and reserve, which is also called capital and reserves. So with what kind of capitals are there? Paid up capital, share capital of investors, such kind of capitals are there. Then reserves are there. What kind of reserves are there? Reserves are also important. Suppose you have retained profit, then you put in reserves, general reserves. Also reserves, such kind of reserves, if you have share premium reserves, that means you have sold your shares, and you have sold out on premium, not only base price but also added some premium. So all those share premium goes to share premium reserves. Dividend, some kind of deferred payment, for taxes, you put in reserves. Sometimes of uh, types of there many types of reserves are there. One is, see, re-evaluation happens of your company, so that appreciation, in your shares, that is also put in reserves. Depreciation are put in reserves. So all these are reserves. Sometimes of capital subsidy, if you get it, these are also put into reserves. So these are capital and reserve, which is also called net worth, of the company. Thereafter, on liability side, there is long-term liability and short-term liability. Long-term liability consider that you have taken term loan from bank, that is long-term liability for you. And you have taken debentures, bonds, from public. You have raised funds, in terms of bonds and debentures, some kind of money you get from your relatives. That is also put in long-term loans if it is for long term. Some deposits are there in your company of other people, that is also long-term liability for you. Third one is, short-term liability, or can consider that, current liabilities, not short-term liabilities, but current liabilities. Long-term liabilities and current liabilities. Current liabilities are, when you have your payables. Suppose your creditors give you certain money on credit, that is also your liability. So bank borrowings, working capital for less than 1 year, interest payment due for 1 year, installment payment due for 1 year, that is also current liability. Next side, right side, if you'll move, you have plant and machineries, land and buildings, furniture and fixtures, and fixed asset, that is also called net block. Thereafter you have, non-current assets. You have deposited some FDs with others, you have invested in your subsidiary companies for long term. So these kind of investments are non-current assets of the bank. Even if you have, taken any kind of deposits you have given as security to banks for long term, that are also counted in non-current assets. Current assets are, your cash, whatever you have, cash in your bank, and stocks, inventories, stock inventories. And thereafter, whatever debtors you have, you have given your, finished goods to someone, they have not paid yet, they are your debtors, then these are debtors are your current assets. And another term is the intangible assets. Your brand of your company, so these are calculated as intangible assets because it has values. That is why it has given a name called intangible assets. Now you have figured liabilities and assets, both sides are equal. Whatever transaction happens on liability side, if it is a credit transaction, debit transaction will happen on asset side. And if it is a credit, transaction on asset side, some assets are due, some debit transactions will happen in liability side. So at the end of the day, both are equal. So this gives you a picture exactly of your business. And if someone wants to check your liquidity, they will come to your current asset and your current liabilities. If current assets, they will take ratios of current asset and current liabilities. Current assets are there, margins is there or not to support any recent cash requirement. So these all things are tested. Thereafter, TOL by TNW in your whenever credit analysis will happen of your balance sheet, in banks, they will look after your TOL and TNW. TOL is total outside liability, where long-term liability, and current liability both are added, TL by CL, TL plus CL, and divided by tangible net worth, which is actually total net worth, capital and reserves minus intangible assets, that is all is tangible net worth. So you take ratios exactly, TOL by TNW, where you understand exactly total outside liability, how much percentage is there of your capital of promoters, tangible net worth of promoters. Is it much more than it would be? That means promoter shares are not significant in the companies. That is what they watch. So they have benchmarks for that. 5:1. That kind of benchmark they set. It should not be greater than that. So that kind of analysis they do based on your balance sheet. So that is why balance sheet comes into picture each and every time. Debt equity ratio, where long term debts only are taken in numerator and divided by tangible net worth. Let's see how much long term debt is there as compared to your tangible net worth of promoters. Only long term, to analyze your term loan exactly that will be paid or not. They also do DSCR, debt service coverage ratio, and interest coverage ratio for your working capital. I will talk about it later, because it will be huge for understanding. So you understood exactly what pictures gives balance sheet. Now comes to profit and loss account, how you will arrive at net profit. There is a business cycle in a business. You bring cash, you bring raw material from cash. Raw material are going to work in progress. It takes time, and work progress after that it gives you finished goods. Finished goods goes to vendors. You supply it to vendors, and vendors after some time they will sell it, and thereafter they will generate cash. They will pay you back. So cash to cash generation takes some time. That is what is called working capital cycle. Working capital cycle, that is what you have to understand exactly how your business cycles run. Thereafter, you understood business cycle, you understood balancing. How will you arrive at profit and loss statement? So suppose, first of all you have to take consider of raw material consumption. What it is. Whatever you do analysis of 1 year. Whenever you will go, you have some opening stock of raw materials. Then you do purchases, and you try to send it for process, work in progress. But whatever opening stock of raw materials is there, you do purchases and minus closing stock of raw materials. These are the consumption of raw material, the raw material consumption. Thereafter you will calculate cost of production. How will you calculate raw material consumption? When you will add, when you will add operating expenses to them. There are certain expenses, there are labors, there are power consumptions, fuel consumptions, and some operating expenses. When you will add to that very raw material consumption, and when you will add opening stock of work in progress and minus closing stock of raw material progress, work in progress, then you will get cost of production. That is what is the cost of production. But you have to bring cost of sales as well. So for bringing cost of sales, you will add opening stock of finished goods and minus closing stock of finished goods in that way cost of production. So that thereafter you will get cost of sales. So this is the cost of sales, whatever finished good you are selling in the market. Total cost of sales you have arrived. Cost of good sales, or cost of sales it is called. When you will minus it from total sales, cost of sales, then you get your gross profit. You have arrived at your gross profit. Understood? You get your gross profit. After that, when you will minus operating expenses from that, you will get operating profit. Operating profit before taxes and before interest even. Then thereafter you debit interest from that, then you will get profit after interest. And when you will debit your taxes from that, then you will get profit after tax, your net profit. That is what happens. Profit after tax, your net profit. That is where you arrived. You understood exactly how trading account and manufacturing account, and thereafter manufacturing trading account, thereafter you got your profit statement. So from arriving raw material consumption to at your net profit, you understood exactly what you have to minus, how you have to calculate. But you have to also understand exactly that cash accruals. Whenever you will add your cash accruals, your net profit to your depreciation, that is cash accruals. And cash accruals is important for DSCR calculation. And whatever you have got at the gross profit, when you in minus the operating expenses, you will get operating profit before interest. That is also called EBITDA. EBITDA is taken for interest service ratio for that period of working capital. So you understand why EBITDA, what is EBITDA, everybody talks about, then you will understand exactly what is EBITDA and what is profit after tax. Profit after tax will be taken as cash accrual. When we will add the depreciation in it, they will calculate for DSCR. When they will add interest on numerator, and cash installment of your term loan, principal plus interest on denominator, they will give you DSCR, debt service coverage ratio. They will analyze it. It is if it will be much more, then it will be easier to service that very loan, and if EBITDA is much more than that of interest generated out of that very working capital, that means it will be serving working capital interest as well. So, and thereafter, fixed asset coverage ratio, fixed asset will cover the loan, term loan or not. Thereafter you have in service coverage ratio in working capital as well. So every picture I have told you in minimum time that I can elaborate to you. But if you will go and analyze with this knowledge, you'll be able to take a deep insight, and everything will be clear in front of you. Profit and loss statements, what are balance sheets, how you will establish your company, and if you really want to learn exactly how you will bring IPOs and how angel investors convert and raise funds from they invest funds, and how they raise profits from market, how they bring enlist their companies as initial public offering, and how they partially exit from the company, how if you convert it to public limited company and privately owned, or if you bring it all together public owned company, how different independent directors will come, how audit will happen, everything. I have talked about everything, so deep knowledge you will get. And video is getting longer. Thank you for listening to me. Thank you for listening to me.